Private funds. You're hearing about them everywhere. They promise these huge returns, the kind that used to be only for the biggest players on Wall Street. But here's the thing. For an everyday investor, that promise can hide a really treacherous trap. Today, we're going to explain the hidden risks you absolutely need to know about.
I mean, who isn't, right? We all are. When the regular stock market feels like a roller coaster, you start looking around, hunting for something that can really grow that nest egg.
And this is the number they dangle in front of you. Investment platforms are pushing these private funds hard, talking about annualized returns in the double digits. And let's be honest, that is incredibly tempting.
Okay, but behind those big, flashy numbers, there's a potential trap. So we're going to explore the real dangers of these funds for individual investors, and we're basing this explainer on some fantastic reporting by Jason Zweig over at the Wall Street Journal.
So first up, let's just quickly break down why these things are getting so much buzz right now. What exactly are we even talking about?
Right, so these are what people call alternative investments. Things like private equity, where a fund buys entire companies, or private credit, where they're lending money directly to businesses. But here's the key thing to remember. You can't just sell them on a Tuesday afternoon like a stock, and that detail, it's absolutely crucial.
Now, to really get a feel for the risk here, let's look at this whole situation through the eyes of someone who, frankly, should have known better. A financial industry insider who put a big bet on these private funds.
And we're not talking about some rookie investor here. Daniel Perlin, and that's a pseudonym, is a guy who used to manage billions at Vanguard. Vanguard, the firm that's basically famous for low-cost, easy-to-access funds. Yet even he got lured in by the promise of high yields, and importantly, what was sold to him as easy access to his own money.
But that promise of easy access, it basically evaporated the second he actually needed it. The real trouble started when an unexpected medical emergency came up and he had to try and pull out some of his cash.
What was supposed to be a simple withdrawal with a 60-day notice, it turned into a total nightmare that dragged on for months. His requests were met with all these delays, a lot of excuses about market conditions, and in the end, he only got a fraction of what he asked for. And that was after taking a big hit on the valuation and paying extra fees.
And this quote, man, it just says it all. This is how an experienced, professional money manager described trying to get his own money back. He ended up having to take out high-interest loans just to cover his bills. It's wild.
Okay, so let's move on because Perlin's story, as harrowing as it is, isn't just a one-off. It's really a symptom of a much bigger issue. The whole system is kind of designed in a way that puts smaller investors at a massive disadvantage.
Just look at this data from Preqin. It paints a really stark picture. When everyday retail investors like you or me ask for our money back, the request fails a quarter of the time. Now compare that to the big institutions, like pension funds. Their requests only fail about 8% of the time. That's more than 3 times worse for the little guy.
And this really gets to the heart of the problem. There's this dangerous knowledge gap. A survey found that a staggering 70% of individual investors just don't fully get the lockup risks. How long their money can be tied up and completely inaccessible. They get sold on the idea of diversification, but they don't see the hidden trap.
So here's the crucial point. It's not about how much money you have. It's about muscle. The big institutions, they have the scale to negotiate better terms, they can demand to see everything, and this is the big one, they have the patience to wait things out for 7, 10, even more years. The average retiree who needs cash for an emergency, you just don't have that luxury.
So after hearing all that, what are you supposed to do? If you're even thinking about these investments, how can you protect yourself? Well, Jason Zweig's reporting gives some really clear, practical advice.
Okay, first off, you've got to limit your exposure. Think maybe 5% of your portfolio max. You also have to dig into the fine print and look for these gate clauses that let them block you from getting your money. And most importantly, you have to ask yourself this really tough question. Could I be totally fine if this money just vanished for a year and a half? If the answer is no, you should probably just steer clear.
And here's what that lack of access can actually cost you, in real numbers. A Vanguard study estimated that being unable to get your money when you need it creates this annual drag on your returns of 1.5% to 3%. Over a lifetime, that could cost an average saver hundreds of thousands of dollars.
And this is why it all matters so much. You see this phrase, democratizing finance, thrown around a lot, but in this case, it can actually be a trap. This isn't just another type of investment. It's a completely different game, with a rulebook written by and for the biggest players on the field.
So ultimately, it really just boils down to this. In the world of private markets, scale isn't just about getting better returns. It's about survival. It's having the power to withstand the storm.
And that's the critical question you have to ask yourself before you go chasing those really tempting returns. Do you have that kind of scale?